So open with me, April 2024. Question 4C. First, you are told that on 1st of January 2023, Kauma Limited issued 10,000 bonds. So if Kauma issued bonds, so that means they are borrowing. Yeah, when the company issue shares, that means they want to get money. So when the company issue bonds, that means they are borrowing money. So therefore, this is a financial liability. So on 1st of January 2023, Kauma Limited issued 10,000 bond instrument with a face value of 100 shillings. Face value is what we call the par value. So that means how much is the nominal value. And in most cases, the par value or the security of the bonds will always mature at their par value. Not unless you are told that it will mature at a premium. So this one will also be our maturity value, of which they issued 10,000 each with a par value of 100. So that means how much they borrowed? So they wanted 1 million. But you're told that on 1st of January 2023, Kauma Limited issued 10,000 bond instrument with a face value of the par value of 100 each at a market price of 95 per instrument. So that means they were issued at a discount. Bond brokers charged fees totaling to 18. Now that's what we call the flotation cost, the cost incurred when you're raising the funds. Yeah, bond brokers charged a fee totaling to 18,000 in addition to the bond. The bond carries a coupon rate of 5% and is redeemable in 3 years at face value. So they'll mature at its nominal value of the face value, which is the par value. It will mature at 1 million. Now the question is, how much was the coupon interest? So to get the coupon interest, this is the amount they agreed at the date of issue they'll be paying each year. And the coupon rate was 5%, so they'll be paying 5% of 1 million. Yeah, the interest is always based on the par value of the nominal value. That means each year they'll be paying an interest of how much? 50,000. And it's redeemable in 3 years. Kauma Limited wished to account for the bond using IFRS 9 financial instrument, specifically the amortized cost model. Yeah, because this is a debt instrument. So use the cost, we amortize. However, there's some confusion about how bond should be accounted for. The cash received from the bond issue was 950,000, has been recognized as an uncurrent liability. That's very wrong. The broker fee of 18,000 were deducted from the uncurrent liability. That's very correct. Carrying amount and a coupon payment of 50 has been expensed in arriving at profit before tax. That's very wrong. We don't expense the coupon interest. We expense the interest based on the effective interest rate. The effective rate of interest is 7.62. Required. The necessary accounting treatment with justification of the above transaction in conformity with the requirement of IFRS 9 financial instrument. So how do you account for this? So how to account for it? We say that initially all the financial instruments are recognized at fair value. Now the question is, how much was the amount of cash received? So to get the amount of cash received, I'll go back to the first paragraph. On 1st of January 2023, Kauma Limited issued 10,000 bond instrument with a face value of 100 each at a market price of 95. So the cash received, they issued 10,000, but they issued at a market price. The par value was 100, but they issued at 95 each. So that means they received an amount of 950. Then this is a liability. So we erase the flotation cost. We erase. Then I told that. The second paragraph. Or the second sentence. Bond brokers charged fees totaling to 18,000 in relation to the bond. So there was the broker fees. This is what we call the issue cost. We incurred an additional 18,000 in order to get this 950. So that's how you recognize the fair value. So how much will you show now? Initially in the financial statement, you get an amount of 932. But in case it was an asset, in case it was a financial asset, for any asset, for example, assuming that is a motor vehicle you are buying, then you incur some cost to install it, that cost you capitalize. In case it's an asset, preliminary expenses are capitalized, so you add it to the cost. But in case it's a liability, the issue cost you eliminate. So these are recognized initially. Then how do you amortize over the next 3 years? So you come up with the amortization schedule. So we amortize for 3 years. When was it issued? On 1st of January 2023. So you have 2024, 2025. So you have the opening balance. And then we determine the interest expense. And the interest expense to be taken to the P&L will be based on the effective rate, not the coupon rate. And the last part of the sentence, the effective rate of interest was 7.62%. Then you less what you have already paid. That is what we call the coupon interest already paid. And that's how we get the balance carried down. So the fair value initially was recognized at 932. Then the coupon interest, this one does not change. That's what we agreed we'll be paying each year. And the coupon interest, each year you'll be paying them an amount of 50. An amount of 50. So now give me the interest for the year at 7.62%. Sorry? 0.18. So to get the balance carried down, you take the balance at the beginning, you add the interest incurred, you raise what you have already paid. That's how you get the balance at the end. $953, 0.18. The closing balance becomes our opening balance. So you have 953, 0.18, 7.62% of that. 620. You take the opening balance plus the interest incurred minus what you have already paid. 9? 630. The closing balance becomes the opening balance. 975, 638, and 7.62%. 344. Opening balance plus the interest incurred during the year minus what you have already paid. That's approximately, is it 1 million? So which that was the maturity period. Good. So that's how you're supposed to account for it, whereby the interest expense, this is what you take it to the P&L, not the coupon interest. And then this one you take it to the statement of financial position as a non-current liability. Good. Can take a screenshot. Open August 2023. August 2023, question 4B. August 2023, question 4B. Question 4B. So 4B, I told that Waigwa Limited is a public limited company quoted on the Security Exchange. The company's capital structure comprises of both equity and debt financing. On 1st of August 2019, the company raised additional finance by issuing a 24 million 4-year deep discounting bond. So they raised funds. So that means this is a financial liability. So financial liability will give rise to interest expense. If it was a financial asset, it will give rise to interest income, and then you show it to the statement of financial position as an asset. But this one, it's a liability. The interest is payable annually in arrears, and the coupon rate of 6%. So how much will be the coupon interest? So to get the coupon interest, so the coupon rate is the rate agreed upon at the date of issue. They agreed at 10%. How much they borrowed? They borrowed 24 million. So that means at the date of issue, they agreed they'll be paying an interest of how much? 14,000. Yes. 40,000. And it was a 4-year deep discounting bond. So to that, the interest is payable annually in arrears at a coupon interest rate of 6% per annum. The bond were issued at a discount of 10%. So that means how much was the cash received? So it was 24 million bond, but was issued at a discount of 10. That means we only received 90% of this. How much did we receive? 21? 21? 21.6. 21.6. And then you told that. And were redeemable on 1st of August 2023 at a premium of 12.17. It will mature at a premium. So how much is the maturity value? So maturity value, this was the coupon or the nominal value, which was 24 million, not about what you received. And then it will mature. It's supposed to mature at its par value of nominal value, but in this case, we are told that it will mature at a premium of 12.17. So how much will be the maturity value? 217,000. The effective rate of interest was 12% per annum. Now, the effective interest rate is what used to determine the interest expense. Also, in case you have to discount the cash flow, you always discount using the effective rate, which is 12%. The issue cost amounted to 1.2 issue cost. That means to raise this money, there was the flotation cost. These are liabilities, so you raise the flotation cost, the issue cost. But you are saying that in case it was a financial asset, the preliminary expenses are capitalized. You are supposed to add. For liability, you deduct. So incurred 1.2. So what you received net is what now we recognize initially at its fair value, which will be an amount of 20.4. Good. The reporting date for Waigwa Limited is that 1st of July. So required. Illustrate how the above financial instrument should be accounted for in the financial statement of Waigwa Limited for the year ended that 1st of July 2020, 21, 2022, and 2023. Around your answer to the nearest 1,000. So these are financial instrument, and therefore being a liability, we use the amortized model. So come up with the amortization schedule. So you have the period ending 2020, 2021, 2022, till mature 2023. So you have the balance brought down. Then we have the interest expense, and the interest expense is determined based on the effective rate. How much was the effective rate? It was 12%. Then you raise the coupon interest already paid, or the coupon cash flow, and that's how we get the balance carried down. Now, the coupon interest does not change. It's an annuity. This is what we agreed we'll be paying each year. 1440 year 1, 1440 year 2, 1440 year 3, 1440 year 4. Then upon maturity, this will be the maturity value. So it will mature at 25 to 17,000. And then initially at the commencement date, it will be recognized at fair value. And this is the fair value, which is 20,400. So you amortize so that you determine how you will be accounting for it in the financial statement at the end of each period. So now give me the interest based at 12%. 24? 48,000. Now take 20.4. You add the interest incurred minus what you have already paid at the end of the year. $21,408,000. So the closing balance becomes the opening balance. So we have 21,408. 12% of that is how much? 25,68,000. So the required, what is in bracket? What are you told? Nimesema soma required, the rest, what is in bracket? You do what? You round off to the nearest? Kwa hivyo itakuwa ngapi? To the nearest 1,000. Itakuwa, this was how much? Kwa hivyo itakuwa 60? Good. You follow instruction. So it's 21,408. You add 25,69. You minus 1440. You are round off to the nearest thousands. 22,537. So the closing balance becomes the opening balance. 22,537,000. 12% of that is how much? 27? 04,000. 22,537. You add 2704 minus 1440. 23? 804. 801. So the closing balance becomes the opening balance. We'll be having 23,801. 12% of that? 20? 56. 23,801. You add 2856 minus 1440. You get an amount of? Yeah, which was the maturity value. So this is what you take it to the P&L as an interest expense or part of the finance cost for each year. And then this one you take it to the statement of financial position as a non-current liability, which will be a 6% bond. Good. So you can take a screenshot. Let's do another one. December 2025. December 2025 question 4B. December 2025 question 4B. Prior to that, Kasuku Limited issued 5 million issued, so therefore it's a financial liability. They issued a 5 million, 18% convertible loan note. Can you write the word convertible? Convertible. So that convertible security in financial instrument, these are what we call compounding financial instrument. And you see that what's a compounding financial instrument? A compounding financial instrument is a financial instrument containing both the debt element and the equity element. Why? This is a debt element, but it's convertible. That means you can convert it into ordinary share. So therefore, this is a compound financial instrument. So compound financial instrument. And this is a financial instrument which contains both the debt element and it has the equity element. And we say that the requirement of the standard is that you have to separate the two, whereby for the debt element, it will be accounted for using the amortized cost model. Then you take the total value of the security. If you eliminate the debt element, the residual will be the equity element. So you separate the two based on the substance. I will read that again. Kasuku Limited issued 5 million 18% convertible loan. So that means how much is the coupon interest? So the coupon interest, it's 18% of 5 million. That 18% represents the coupon rate. An amount of 900. So this is what they'll be paying at the end of each period. So Kasuku Limited issued 5 million 18% convertible loan at par on 1st of November 2022 with interest payable annually in arrears. 3 years later, so the maturity period is 3 years, or it's convertible in 3 years. On that 1st of October 2025, the loan note became convertible into equity shares on the basis of 100 shillings of the loan note for 50 equity shares. Or it may be redeemed at par in cash at the option of the loan note holder. Kasuku Limited accountant has observed that the use of the convertible loan note was preferred to an unconvertible loan note, as the rater would have required an interest rate of 12% in order to make it attractive to the investor. So can you add in 24%? So 24% will represent the effective interest rate. We represent the effective interest rate. Yeah, because that is the market interest rate. To attract the investor, you have to give them at the current market rate, which is 24%. The present value of 1 shillings receivable at the end of the year, based on the discount rate of 18% and 24%, are given below. So given at 18% and at 24%. Remember, you see that when you are discounting, you discount. You don't discount based on the coupon rate. You discount using what? The effective rate. And what's the effective rate? 24%. Required. The accounting treatment of Kasuku Limited convertible loan note. So how do you account for the convertible loan note? It's a compound financial instrument. You separate the debt element and the equity element. So how do we measure the debt element? The debt element will be measured using amortized cost model. Measured at amortized cost model. That is, how do we amortize? Determine the present value of the future cash flows. The present value of all the future cash flow. And therefore, how do we get the debt element? To get the debt element, you take the present value of an annuity plus the present value of the maturity value. So once you determine the present value, that's how we determine now the debt element. Or alternatively, you can separate them. So how much is an annuity? The annuity is this interest they'll be paying each year, 900, 900, 900. Then you add the maturity value. It will mature after 3 years. So we determine the present value. So therefore it will be present value of an annuity. The annuity in this case is our interest. So, or alternatively, you do this. We have the period. How many years? Year 1, year 2, year 3. we have our cash flows. Year 1, you receive an interest of how much? 900. Year 2, you receive an interest of how much? 900. Year 3, you receive an interest of how much? 900. And then it matures at the end. You get back an amount of how much? You pay back the 5 million. Remember, the debt instrument was 5 million. That was the par value, and they always mature at their par value. So at the end of year 3, it will be an amount of 5.9. Then you discount present value interest factor at 24%. And that's what you're given. Year 1 is 0.806. 0.806, 0.650, 0.524, and that's how I get the present value. 725, 400, get 585,000. Sorry, 3091, 600, and that's how we get the debt element at amortized model. You take the present value of the future cash flows. Yes? 4402. That's the debt element. So how do we get the equity element? Yeah, so to get the equity element, you take the financial instrument value. The financial instrument value was 5 million. It was 5 million. You eliminate the debt element, 4202. The residual is what is deemed as an equity element. The residual. 58,000. But actually, the question I did in class, the one for compounding, it was the same question. The same question. Then, now for the equity element, this one does not change. But for the debt element is the one now that you amortize for the 3 years. So you come up with amortization schedule. We're only amortizing the debt element. And we see that for the debt element, they'll always mature at their par value. So here we have the period. It was for 3 years. So we have the balance brought down. Then we have the interest expense. The interest expense will be determined based on the effective rate, which is 24%. Then there was the coupon interest. And then that's how you get our closing balance. Balance carried down. So the balance brought down, we are amortizing the liability. And this was the fair value of the debt element at the beginning, which would be an amount of 4402. Then the coupon interest does not change. This is what we agreed we'll be paying at the end of each year. 900, 900, 900. Then upon maturity, if you don't convert, they'll still mature at their par value. And the par value of the debt element was 5 million. You don't get 5 million, automatically know that you are wrong. So this would be the fair value initially at 24%. 10? 480. So you take the balance brought down, add the interest expense, minus what you have already paid. 45? 480. The closing balance will be our opening balance. We have 45, 58, 480. 24%. Sorry? 1094. 035. Opening balance, interest expense minus what you have already paid. 4752. 15. 515. The closing balance will be opening balance. So we'll have 4752, 515, 24%. 1140. 604. That plus that minus that. You get 49? Sorry? 49. Yeah, so it's due to rounding off. Then, how do you account for this? This one you take it to? This is what you take it to the P&L. This one you take it to statement of financial. Now, what was the question? We haven't answered the question. Now, the question was, the accounting treatment for Kasuku Limited convertible or not in number one, statement of profit or loss. So, number one, we can come up with the statement or profit or loss extract. So you have year 1, year 2, year 3. So under the expenses, there is the finance cost or the interest expense. So the interest expense, this will be 10, 56, 480. This will be 10, 94, 035. This will be 11, 40, 604. Then number 12, the question was, statement of financial position as at 31st of October 2023, 2024, and 2025. Statement of financial position. What do you take to the statement of financial position? So to the statement of financial position, it's an extract. So this was 2023, 2024, 2025. Here you have two elements. So under the equity and liabilities, so we have an equity reserve. They have not yet converted. So it will only become an ordinary share capital when they exercise or when they convert. And the equity element does not change. So this is 598, 598, 598. That means after 3 years, as at the end of 2025, if you exercise, if you convert them, so what will happen? Now you eliminate the liability, now you recognize an equity or ordinary share capital, an amount of 598. But by then, because they have not yet converted, it will still remain a reserve. And then under the non-current liability, we had an 18%. It was convertible what? Yeah, convertible loan. Convertible loan. So here you recognize this amount of 4558 for 80. This was 4752 515. Good. So you can take a screenshot. Can see, try another one. April 2025. April 2025, question 5B. April 2025, question 5B. Question 5B, I told that. On 1st of October 2022, Ben Limited acquired an investment. They acquired an investment. So if you acquired an investment, is it a financial asset or financial liability? This is an asset. Good. They never issued for them, they acquired. So that means they invested. So it's an asset. So on 1st of October 2022, Ben Limited acquired an investment in 5%. Now the 5% represent the coupon. Great. An investment in 5% loan note with a nominal value of 60 million. So how much will be the coupon interest that you agreed? Remember, this is an asset. Now, the coupon interest is what you agreed you'll be receiving at the end of each year. So the coupon rate is 5%, had invested in a 60 million. So this is what we agreed. I'll be paying you. So that means this is what you'll be receiving at the end of each year. This is what you'll be receiving, but not what you'll be earning. Are you together? Yes. We prepare the financial statement on accrual basis. The one we have done for the liability, there is what you are to pay. That's what we call the cash basis. But there is what you incurred. So you take it to the income statement, what you incurred. Now, in this case, not what you received, what you earned. So on 1st of October 2022, Ben Limited acquired an investment in 5% loan stock with a nominal value of 60 million at a discount of 5% and incurred 1.2 transaction. That's enough. So how much is the cash paid or cash invested? So it's 60 million, but there was a discount of how much? So that means you only paid an equivalent of 95. So is it 57? So you only paid 57. Then in the process of investing, you incurred some cost. That's a preliminary expense. And preliminary expense, this is a financial asset. We add or erase? We add. Good. It's known as the preliminary expense. The transaction cost was 1.2. You incurred 1.2 in order to get this investment. So what you recognize will be the fair value. Look at the amount of 58. 200. Good. And then I told that the stock will be redeemed at a premium. So how much will be the maturity value? See that for all the instruments, they always mature at their par value. And the par value, not what you paid. No, it was a 60 million loan stock. But now you are told that it will mature at a premium. It will mature at a premium of 35.76. So it will mature at 63,576. So that's the maturity value. The effective rate of interest on the loan stock approximated 8% per annum. Ben Limited operates in a business model where it holds debt financial asset to collect contractual cash flow comprising of the coupon interest payment and capital repayment on redemption, but also to sell the asset if the opportunity for investment with a higher return arises. Now, being a financial investment, based on that information, you might not understand what they mean. But what they mean is that this is what we call a financial asset at fair value through OCI. It's an asset. That means also they monitor the fair value changes. The fair value changes to determine whether there's a gain or loss. But remember, it's a financial instrument, which is a debt element because you invested in a 5% loan stock. This is what should be the financial asset at amortized cost. But you being an asset, you see, for the other question you have done for liability, you cannot revalue your liability. So, liability you cannot revalue. If you take a loan of 50 million, so you cannot revalue that loan. Not allowed to pay. But for the bank, to them it's an asset. They gave you a loan. So sometimes they can assess for impairment. Waone huyu customer venye anaenda anaweza kosa kulipa. So they assess for impairment. They can do a revaluation. When you hold it as an asset, you can revalue. Sawa. So when you revalue, that's when you recognize the fair value changes through OCA. But in this, it's a liability on your side. Liability, you don't revalue. But this one is an asset. Then we're told that the credit risk on the loan stock has been significantly low and expected credit losses are negligible. The fair value of the loan stock was follows the fair value. So that means they adopted the fair value model of valuation instead of amortized cost model. So the 30th of September 2023 was 66 million. 30th of September 2024 was 62.4 million required. Using suitable calculation, illustrate the accounting treatment of the above transaction in the financial statement of Ben Limited for the year ended 30th of September 2023, 2024, and the year ending 30th of September 2025. So it was for 3 years. And out of your answer to the nearest? 1,000. So how do you account for it? So when accounting for it, now this was a debt instrument. You are making a revaluation. So first of all, what you can do, first of all, start with the investment measurement on amortized cost model. You see, in this case, it's special because you are given the fair value at the end of each year. So that means they're using the fair value model. So first of all, let's do the normal amortization. Whereby you have the period. And the first financial year ends on 2020, 2023, 2024. Therefore, go up to 2025. So we have the opening balance. And there is the interest. Now this will be the interest income. And the interest income or interest expense will be based on the effective rate. How much is the effective interest rate? Sorry? 8%. Then there is the coupon interest. And then you get the closing balance. That these are financial assets. And you are told that you round off your figures into the nearest 1,000. So now give me the balance brought down. Now the balance brought down is this fair value, which is an amount of 58,200. The coupon interest will not change. This is what you agreed you'll be receiving at the end of each year. So 58.2, 8% of that? 46,000. So take 58, you add 46 minus what you have received. Get 59. 50? 59? 856,000. The closing balance becomes our opening balance. We have 59,856. 8% of that is how much? 47? 88. That plus that minus that. Yes? 644. The closing balance becomes our opening balance. We'll be having 61, 644, 8% of that. That one, That two. 61, 644 plus 49, that two, minus 3,000. You get 63, 576. Is it the same as our maturity value? Yes, the maturity value was to mature at a premium. Good. So now how do you account for it? How do you account for it? This is what you take it to the P&L as an income. What do you take to the statement of financial position? The balance? That's very wrong. In this case, you are not accounting at amortized cost model. You are revaluing it. And so there is a reason why I've done this. So now amortization schedule, now based on fair value model. Based on the fair value model. So here we have the period 2023, 2024, 2025. We have the balance brought down, nothing is changing. Here we have the interest income at 8%. Then there is the coupon interest, so that we get the balance carried down. Now, the balance carried down is what we call the carrying amount. The carrying amount. Then you compare against the fair value, and that's how we determine the fair value changes. It can be a fair value gain or the fair value loss. Can you go to the last paragraph? The credit risk, or we go to that paragraph. When Limited operate in a business model, it holds the debt financial asset to correct the contractual cash flows comprising of the coupon interest payment and capital repayment on redemption, but also to sell the asset if the opportunity for the investment with a higher returns arises. The credit risk on the loan stock has been significantly low and expected credit losses are negligible. The fair value of the loan stock were as follows. The fair value. So as at 30th of September 2023, it's an amount of how much? 66. As at 30th of September 2024 was an amount of how much? It was 62. And then for the final year, that's when we expect it to mature, right? And it's supposed to mature at how much? 63,576. Are we together? Now note that. Now listen up here. I don't want to get confused. I borrowed from you. Are we together? I borrowed from you. So that means to me it's an asset or liability. To me it's a liability, right? So this is how I'm supposed to account for it, me now. But now, in my books, instead of showing an interest income, it will be interest expense. This I will be amortizing. In your books, you are the one who have decided to revalue, not me. So, but nothing will change from me. So that means, now listen up. The coupon interest will not change. Each year will be an amount of how much? It will be 3. This is what we agreed. I'll be paying you each year. So that means to you, this is what you'll be receiving. The interest income, the same. So, this is what I'm supposed, the interest incurred by me will be the interest earned by you. So year 1, because for me, I'm not doing any revaluation, was supposed to be an amount of 46.56. This was an amount of 47.88. This was an amount of 49.32. There is nothing I'm changing here. Don't show where now the valuation comes in. Now let's start with the first year. The balance brought down does not change. It's an amount of 58,200. This was the interest income minus what you have received. How much will be the balance carried down? It will be an amount of 59,856. Are you together? But now you have decided to revalue the asset. This is the balance carried down, which will be the carrying amount. But the fair value at the same date, Ningapi? So 59, but the fair value is 66. Is it a fair value gain or fair value loss? Again, gain yangapi? Now show, give me the gain. So it's supposed to be 59, but you decided to revalue. At the end of that first financial year, it had a fair value of 66. Sorry? 61,44,000, right? Now let me ask you a question. You are the one revaluing, not me. Are you together? This was the carrying amount, this was the fair value. Now, when preparing your financial statement, how much will you show as the value of that available for sale? Because this is available for sale, it's an asset. How much will you show in your financial statement as an uncurrent asset? Is it 59 or 66? 66, the revalued amount. So that to other comprehensive income or to the revaluation changes, you show a gain of how much? 61. So that means you show an amount of how much? 66. So if this is what you'll be showing, that means the closing balance becomes the opening balance. So at the beginning, this is not what you'll show. Now you'll show what you're showing in your financial statement. The closing balance becomes the opening balance, an amount of 66. Now, you will not earn income based on your valuation. Tuko pamoja? You will not earn income based on your valuation because tukitumia hiyo utakuwa na revalue juu so that you earn more interest. So that means you'll earn the interest you are supposed to earn, assuming you never revalue. And that's why I've said that this was the normal at amortized cost model, assuming there is no revaluation. So now you'll take 66. You earn the interest you are supposed to earn without revaluation. You received what we agreed. So now take this plus this minus this. Give me the new carrying amount. 67, 88. This is your carrying amount. Then at the end of year 2, you revalued again. And how much was the fair value? 62. The carrying amount is 67, and the fair value is 62. Is it a fair value gain or loss? A loss. A loss of how much? Sorry? 53? 88,000, which is a loss. Carrying amount was 67, the fair value was 62. So how much did you show in their financial statement? You show an amount of 62. If this is what you show at the end of the second year, it becomes the opening balance at the next financial year. You start with an amount of how much? 62. This one? Yes. It was supposed to be 62,400, eh? 62,400. So that means how much is that? This one is okay, eh? So it will be 62,400. Then your valuation does not affect what you're supposed to earn. So therefore, you earn the interest that you are supposed to earn, assuming there was no revaluation. So 62,400, we add 49 minus 3. 64? That 1,000, eh? Good. So this will be your carrying amount, but now it's maturing. How much is the maturity value? 63. So from 64 to 63, again or loss? A loss. A loss of how much? Yes? 756. Good. So how are you supposed to account for it? Now, the interest income now, using the fair value model, is what you'll take it to the P&L. And then the fair value is what you take it to the statement of financial position. The fair value changes. This is a long-term financial asset. Long term, we say that they'll be measured at fair value with any changes in fair value taken to OCR. OCR, good. So in short, this is what I mean. What do you take to the P&L? So to the income statement. We have 2023, 2024, 2025. This was a financial asset. So therefore, under the incomes, we'll be having the interest income. You can use this one, you can use this one. The interest income and is the same. So it will be an amount of 56,000. Year 2, an amount of 47,800. And then year 3, you earned an amount of 49. 32. Then, under other comprehensive income, there is the fair value changes. Okay. Is an amount of 61,44. This was a loss of 15,388. This was an amount of 750, 756. What about the statement of financial position? So here you have 2023, 24, 2025. So under the non-current assets, there was a five, but you don't, for the asset, you don't have to show that. This is what you call available for sale or financial asset at fair value through OCR. Remember, you said that financial assets are classified into three: financial asset at fair value through P&L, financial asset at fair value through OCR, also known as available for sale. Or you can just call it investment. Now you take the fair values. This one, it is 66. This one was 62.4. And then upon maturity, you recognize an amount of 63,576. And then also you can show, but you have already shown it here, under the equity, that's when now you show the revaluation reserves. Now, if you recall, we said that anything that goes to other comprehensive income, that is revaluation changes for PPE and available for sale and intangible assets, they are taken to OCI. And anything that goes to OCI is part of revaluation reserve. So this was supposed to be 6144, 5388, and this one was 756. Good. So you can take a screenshot. So actually that question was a replica of this question, December 2021. To test your understanding whether you have understood, you can try this question, question 3B. So I give you 2 minutes break. I will do some question on income taxes. September 2021, question 3A. But I want us to evaluate some question on deferred tax. You say that what's a deferred tax? Deferred tax is the tax payable or recoverable in the future, which arises as a result of the temporary differences. You see that the temporary difference is the difference between the carrying amount and the tax base. And what is the carrying amount? Is the amount of an item shown in the financial statement? Yeah, the amount of an item shown in the financial statement after doing all the necessary adjustment by you as an accountant. Then we see that the tax base is the amount of an item allowable for tax purposes in the future, and therefore this will be determined by the taxman. So this is the taxman. You see that therefore the temporary difference is the difference between an accountant perception and the taxman perception, the difference between the two. Good. Then we see that for the temporary differences, there are two types of temporary differences. There is the deductible and there is what? The taxable. Deductible temporary difference and the taxable temporary difference. Good. Let's start with question 3, part 1. With reference to deferred tax, differentiate between a permanent difference and the temporary difference. So you can write. Permanent differences are irreversible. Permanent differences are irreversible. While temporary differences, TD, the temporary differences are reversible. You can write another difference. Permanent differences, can write PD. Permanent differences is the difference between accounting items and taxable items. Now, what do you mean by that? Don't write. So that's for example, for expenses is the difference between an accounting expense and taxable expense or allowable expense, or taxable revenue and accounting revenue. So that's what we mean, the difference between accounting and taxable item. While TD, those are the temporary difference, while TD is the difference between carrying amount, is the difference between the carrying amount and the tax base. Is the difference between the carrying amount and the tax base. Those are some of the differences between the carrying amount, or the permanent differences and the temporary differences. Number two. Huruma Limited, a public limited company, has a portfolio of investment including various subsidiaries and also undertakes various projects varying from debt factoring to investing in property and commodities. And the following information was extracted from the group financial statement relating to the deferred tax provision for the year ended 31st of March 2021. Number one. Huruma Limited acquired a controlling interest in a subsidiary, that is Sukari Limited, on 1st of July 2020. The fair value of the assets and liability acquired were considered to be equal to the carrying amount with the exemption to freehold property. So the first item here is the freehold property with the exemption to freehold property, which had a fair value of 256 million and the tax base of how much? 240, which had a fair value. Now, you as an accountant in the financial statement, you recognize them at fair value, and the fair value recognize an amount of how much? 256, but to the taxman, the amount that will be allowable for tax purposes, as the tax base, will be an amount of 240, 248. So take 256 minus 248, get 8, right? Yeah, which is positive. It becomes a taxable temporary difference. Number two, during the year ended 31st of March 2021, Huruma Limited sold goods. Huruma sold goods. Now, these are a group of companies. So if they sold goods, so when it comes here to the determining the temporary differences, our key concern is on the statement of financial position items, assets, liability, and equity. So if we sold goods, so our interest is not about the revenue. So our interest is the closing stock. That is the inventory. Now, as an accountant, whenever there is intergroup sales are eliminated in full from both sales and the cost of sale. That's for the income statement. Now let's go to the balance sheet. So to the balance sheet, we recognize now the closing stock. And for the closing stock, we always eliminate the unrealized profit on closing stock. Good. But listen up here. When you go to the taxman does not recognize any group aspect of taxation. Taxman hajui a group of companies. He assesses each company individually. So therefore, if parent sold to subsidiary or the subsidiary sold to the parent, to the taxman you atakaye kusikia. To the taxman, that's a normal business to business transaction. Ni wewe tu as an accountant, unajua that this is a group of company. As an accountant, you are the one to do the adjustment. That is for unrealized profit, it a group sales. But to the taxman, usimwambie hiyo, because anajua that is a business to business transaction. If you sold, you made a profit. So anataka profit yote. As an accountant, the profit within the group, you nitanga unrealized profit. You adjust by eliminating. Now, the difference in that perception between you now and an accountant on that aspect, it will give rise to temporary differences. So you are told that. Number two, during the year ended 31st of March 2021, Huruma Limited sold good at a price of 48 million to another subsidiary, Wingu Limited, and made a profit of how much? 16 on that transaction. Tuangalie hapa sasa. Tusiendelee sana. Sasa huyu ni wewe. How much was the intergroup sales? You sold good worth how much? 48. You made a profit of how much? So as an accountant, you eliminate that unrealized profit. Yangapi? 16, so that you recognize the actual, remember inventory is recognized at cost, not at selling price, right? But what we need, these were the sales. What we need is the closing stock. And then you are told that 40% of these goods were held in the inventory of Wingu Limited as at that 1st of March 2020. So you sold at 48. You made a profit of 16. You eliminate 16 to determine how much was the cost of goods. But what we need is the closing stock. How much do you have at the end? 40%. So how much is your closing stock as an accountant now? 12 point? Twende kwa KRA. To the taxman, you sold goods worth how much? 48. Hiyo ni kuuza uliuza. Kama uliuza make profit. Sawa sawa. So to the taxman simwambia kuna unrealized profit hapana. That was a business to business transaction. So the sales was 48, but in this case, we don't want the sales. We want the closing stock. How much do you have at the store? You retained with 40%. So to the taxman, you don't adjust by eliminating the unrealized profit, but an accountant, you eliminate. So to the taxman is an amount of 90. We make profit. So 12.8 minus 19.2, 6 point, negative, becomes a deductible. Good. Number 3. Huruma Limited has a portfolio of financial assets. So you also have a financial asset. Huruma Limited has a portfolio of financial assets comprising of readily marketable government security, which are held as current assets in the for financial trading purposes. So they are held as a current assets. That's what we call financial asset at fair value through P&L. And we see that these are short-term financial assets. Then you are told that this investment are stated at fair value in the statement of financial position. Yeah, you recognize them at fair value in the financial position. And any gain or loss are taken to P&L, profit or loss. These gains or losses are taxed when investment are sold. That means on cash basis. Currently, the investment have a market value of how much? Market value to fair value. So. And you as an accountant, you recognize them at fair value. So fair value ni ngapi? 412. Twende kwa taxman. Taxman does not recognize any revaluation gain. So. Atauliza mimi usiniambie how much was the gain. How much was the actual cost or amount you have invested? Then you told that. And accumulated unrealized gain ngapi? Kwa hivyo this is the fair value 412. Haujauza. So that means the fair value gain haujarealize sawa. So na kuna profit ya ngapi ya 60? So that means how much was the actual cost you had paid to acquire for this investment? 340? Yeah, even for those who are taking tax, Mr. Lawrence has told you that unrealized gains are not taxed. We only tax the realized income. So therefore, this 64 is just a gain. We have not realized them. So it means that determine how much was the actual cost. And you get a difference of how much? 64, which is a gain. Number 4. Huruma Limited loan asset. So it's a loan asset. It's not a liability. Loan asset means that they give a loan to another company. So to them, it's an asset. It's still a financial instrument. Huruma Limited loan asset at a carrying amount of how much? You are given carrying amount. This amount shown in the financial statement by you after making all the necessary adjustment. What about to the taxman? Huruma Limited loan asset had a carrying amount of 168 million after an allowance for credit losses of 30. After a provision, an allowance. That's what we call provision for bad debt. So you give a loan to another person. But in this case, you have made a provision that too might not be recovered. That's why they have made an allowance. When you go to the taxman, they does not recognize any provision or any allowance, not unless they become specific bad debt. So this was the carrying amount. What does it mean? That means you have already done the adjustment. So there was an allowance of 30 that you might not receive your money. So that means ulikuwa umetoa ama ulikuwa umeongeza? Ushatoa. Good. So for taxman, you have to disagree. Kama ulikuwa umetoa unafanya nini? You add back 168. Ulikuwa umetoa provision ya ngapi? You add it back to determine how much was the actual amount had you given as a loan? 200. So that you take 168 minus 200, you get a difference of, which is a deductible. Can you read that point again? Huruma Limited loan asset had a carrying amount of 168 million after an allowance for credit losses of that 2 million based on a 12-month expected credit loss. Tax relief is only available when the specific loan is written off. That's what we call a specific bad debt, not general provision for doubtful debt. So they only be allowed when they become specific. So that means kama ulikuwa umetoa that too, you add it back. That one becomes a disallowable. Number 5. Huruma Limited has unrelieved trading losses. Trading losses. Huruma Limited has unleashed trading losses of 20 million as at 31st of March 2021. These unused tax losses, you can also call them unused tax losses. These unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and it's highly expected that taxable profit will be available in the. Can you read that again? Read it and you read it slowly. Read it and read it slowly. That's enough. Now let me ask you a question. You're in advanced level. You have been preparing financial statement, right? Mostly the statement of financial position, because you see that our key concern here is the assets, liability, and the equity. So you see, PP is recognized as a what? PP is recognized as a payable liability. Now, have you ever seen trading losses or any tax losses? Have you ever seen? That means how much the carrying amount? 0. Tax base ni ngapi? 20. The difference ni ngapi? Okay, in short, this is what it means. Si mnafanya tax. If a company operates at a loss, do you tax? You don't tax. Sawa. But hiyo loss for that year, unaambiwa it can be carried forward. It can be written off against the profit for the next how many years? Oh yes, unaona mmenijibu vizuri. It can be carried forward. So that means if the company operates at a loss is not taxed. Sawa. And that loss becomes an allowable expense. It can be carried forward for the next 4 years. So that means it will be allowable for tax purposes in the future. What is tax based? To say what is tax based? Amount allowable for tax purposes in the future. We are told that during the year we did a restructuring. Restructuring inakuanga very expensive. That's why the company made a loss. So therefore, to the income to the statement of financial position, there is nothing you show. This one is not an asset, it's not a liability. So that means to the carrying amount to you as an accountant, there is nothing to show. But this loss of 20, for tax purposes, it's allowable for tax. It can be carried forward for the next 4 years. So this 20 becomes allowable for tax purposes in the future. Number 6. On 1st of April 2020, Huruma Limited deferred tax account had a nil balance. So the opening balance was 0. Assume a corporate tax rate of how much? That. Now give me the temporary differences. What should be the temporary differences? $13 point, which is positive, right? It's positive becomes a net taxable temporary difference. So if it's a taxable temporary difference, it gives rise to deferred tax liability. Deferred tax liability. So you'll be taking the 30% of the taxable temporary difference of how much? 0.8. And this one you take it to the non-current liability as a deferred tax liability required. Determine the deferred tax assets or liability for Huruma Group as at 31st of March 2021 in conformity with IAS 12 income taxes. So you can take a screenshot. Do another one. August 2022, question 2B. August 2022, question 2B. To be told that T Limited, a public limited entity, is a holding company in a group of companies. The foreign transaction relating to deferred tax were extracted for the purposes of finalizing the group financial statement for the year ended 30th of April 2022. Number one, T Limited owns property, plant, and equipment. So the first item is the PPE. So owns an item of PPE at a cost of 625 million when it was purchased. Now that was the cost. A depreciation of 250 million has been charged up to the reporting date as at 30th of April 2022. So we want to determine the net book value or the carrying amount of the PPE. And we are told that, we read that again. T Limited owns property, plant, and equipment at a cost of 625 when it was purchased. A depreciation of 250 million has been charged up to the reporting date of 30th of April 2022. So you minus 250. So that means at the reporting date, how much was the carrying amount? It was an amount of 375. This will be the carrying amount. The entity has claimed a total capital allowance on PPE, an amount of how much? So now tuende kwa taxman. Taxman does not recognize depreciation. They recognize capital allowance. How much was the cost? The cost of P was 625. Then you have claimed the capital allowance, an amount of how much? So that means now the remaining, the written down value is the amount allowable for tax purposes in the future, which will be an amount of 325. But the carrying amount is an amount of how much? 375. Then we are told that on 30th of April 2022, that's the reporting date, the property, plant, and equipment was revalued to 517. This was the carrying amount, but at the reporting date, you revalued. Now, the question is, you as an accountant, how much do you show in the financial statement? Is it the net book value of the revalue or the fair value? Fair value. So you recognize the carrying amount, you show the fair value, which is an amount of 517. So 575 to the taxman is 325. How much would be the temporary difference? Sorry? 250. From 375 to 575, how much is a revaluation gain? A gain of 200. Remember, I said that revaluation changes for PPE and available for sale, they are subject to a special deferred tax treatment. Do you remember that? Yes. The revaluation changes for PPE and available for sale, they are subjected to a special deferred tax treatment. Number two, on 31st of October 2021, the company completed a development project and incurred a cost of 200 million, which it capitalized in accordance with IAS 38, intangible assets. Intangible assets. We know that on that 1st of October 2021, can you outline the date? Outline the date. Asoma hapo juu. When is our reporting date? 30th of April 20. So we completed on 31st of October 2021. Use your fingers. How many years or how many months to the reporting date? 6 months. Good. Now we can read it again. On that 1st of October 2021, the company completed the development project and incurred a cost of 200 million, which it capitalized in accordance with IAS 38 intangible asset. The estimated economic useful life of the intangible asset was 5 years as at 31st of October 2021. The company obtained full tax relief for research and development expenditure on cash basis paid. Now we want to determine the carrying amount. So remember, these are intangible assets of which you are given, whenever you're given the estimated economic rate, that means you charge amortization. How much did you incur? How much was the cost? 200. The estimated economic rate was? So how much are you supposed to charge each year? 40. How many months? 6. So that means at the reporting date, you are supposed to charge amortization of how much? 20. So that means for you as an accountant, the cost was 200 minus amortization of 20. So that means the carrying amount will be 1. What about the tax base? 0, correct. Remember, I said that for intangible asset, the tax base is always equal to 0. And even you are told the last sentence. The company obtained full tax relief for research and development expenditure on cash basis. When you incurred this 200 6 months ago, that's when you paid. So it was allowed for tax purposes in full. So therefore, the tax base is amount allowable for tax purposes in the future. But this 200 was already allowed in full, nothing to be allowed in the future. That's why the tax base for the intangible asset will always be equal to 0. Good. Number 3. During the year ended 30th of April 2022, T Limited transferred good worth 1,500 million to one of its subsidiaries. That's the intergroup sales. So for the intergroup sales, what we need is the closing stock. That is the inventory. You sold good worth how much? 1,500. Now this is you as an accountant now. For an accountant, first of all, you eliminate any unrealized profit. But to the taxman does not eliminate. So to the taxman will be 15, also to its 15, then we adjust. That during the year to 30th of April 2022, T Limited transferred goods worth 1,500 million to one of its subsidiaries. T Limited made a gross profit margin of how much? 20%. Will make profit yangapi? Kwa hivyo of this 15, acha na calculator. Of this 15, you made a profit of how much? 20% to a 20%. How much is the cost? 80%. So 80. So that you remain with the cost. Hapa usitoe unrealized profit. It was a business to business, so you made the profit. But what we need is closing stock. Then you're told that 1/3 of the goods remained unsold. So 1/3. So to the taxman, you just take the full amount, 1/3. So this will be 500. 400. Good. So number 4. Trade receivables. We have receivables. Trade receivable were carried in the consolidated statement of financial position at how much? Were carried. What is that? Carrying amount. So they were carried at 480 million. This was after an allowance of doubtful debts of how much? 60. And unrealized foreign exchange gain of how much? 80. The allowance for doubtful debts and foreign exchange gains or losses are only allowed for tax purposes when realized. So 20 per taxman. 480 after you had made an allowance provision for bad debt. So that means we umetoa. So you are just by doing what? Adding it back. An amount of. Then there was unrealized gain. Gain income or money expense. It's an income. That means you expected to receive. So if you expected to receive, so you umeiweka hapo as a receivable. But you know that it's unrealized. So you are not supposed to recognize it. So you do what? You eliminate. Get 400 and You get an amount of, so in short, you add back the expense, you eliminate the income because this income is unrealized. Then this 60 was not specific. Number 5. On the deferred tax liability account for T group as at 1st of May 2021 was 25. That was the deferred tax balance brought down. Number 6. The income tax rate applicable to T Limited for the year ended 30th of April 2022 was 30%. Now give me the total. $300. And if it's positive, it means that it's a net taxable temporary difference. A taxable temporary difference will give rise to a deferred tax liability. So we take 30% of 350. Is it 105? 105. This one, you take it to the non-current liability as a deferred tax required. Compute the relevant temporary differences as at 30th of April 2022. Number 2, deferred tax account. So how do you prepare the deferred tax account? So for deferred tax, being a liability, the opening balance will be on the credit side, and you are given in note number 5. The balance on the deferred tax liability account of T Group as at 1st of May 2021, it was an amount of 25. Then now we have 105. That one will be our closing balance. So the balance carried down, it's an amount of 105. Then we said that revaluation changes for PPE and available for sale financial assets are subjected to a special deferred tax. If it's a gain, you see, we see that when we have the balance brought down, it attracts increase. Balance carried down attract reduction. So if you revalue at a gain, you pay more tax. Again, you pay more tax. So therefore, here you factor in the revaluation gains, but only for 2 items. PPE available for sale. In case it's a loss becomes a deductible, it reduces. Balance carried down attracts reduction. So you factor in the revaluation losses. But you're saying that only for those 2 elements. So here we didn't have any available for sale. But did we have a PPE? Yes. Was there any gain? Yes. PPE, there was the revaluation gain. A gain of how much? 200, not this 250. Of this 250, the revaluation gain was 200. So you take 30% of that 200, you get an amount of 60. This side is still more. 105 minus 85, you get 20. Is that 20? And now this 20 is what you take it to the P&F. And the balancing figure, it's on the where we have the balance brought down, it's an increase. So from 85 to 105, it's an increase. You see that an increase in deferred tax becomes a what? An expense. Yeah, an increase in deferred tax liability becomes an expense. Can take a screenshot. And try another one. August 2025. August 2025. Make sure that for every question we do, don't have to understand everything. Make sure you are getting at least one concept. This now you are able to remember that for the valuation changes for PPA, they are subjected to special deferred tax. Also for the intangible asset, the tax base is always 0. So August 2025, question 5B. Mhm. So question 5B after that. The financial accountant of Auma Limited is in the process of finalizing the company's financial statement for the year ended that 1st of July 2025. The following matters are being considered for deferred tax purposes. Number one, at the year end, Auma Limited property, plant and equipment, so our item is PP, had a tax base and a carrying value of 72 and 95. So how much was the carrying amount? 95. How much was the tax base? Give me TD. Is it 23? 23, which is a taxable temporary difference. Number two, the company provision for decontamination. Provision. What is a provision? A provision is a liability. For example, the deferred tax itself, it's not an actual tax. It's a provision for tax payable in the future. So provision is a liability. A provision is a liability. So the company provision for decontamination cost was 11 million at the year end. So that means you as an accountant, you expect. Do you know what is decontamination? Yeah, so we are expecting, those are the costs we expect to incur. So if you're expecting to incur, what's the definition of liability? Liability is anything that you expect an outflow in the future. So you had made a provision of how much? 11. You are the one doing that provision. I've said, what's the provision? The liability. Good. Do you know what we said about the liability for deferred tax? Is liability as shown as what? Negative. Sawa. Taxman, tuende kwa taxman hata before tusome hiyo ingine. Taxman does not recognize any provision. Kwa hivyo tax base ni ngapi? Zero. Kwa hivyo itakuwa ngapi? Now we say that liabilities are recognized as negative. So it will be negative. We do that. Negative 11 minus negative 0. What's the difference? Nipe hiyo. What are you getting? You're getting negative? Is it negative really? That's why you have a calculator. It's 11. Is it positive or negative? Good. So we do that again. The company provision for decontamination cost was 11 million at the year end. So you see, that's a provision. Provision is made by an accountant, not by the taxman. So that means in your financial statement, that's when you show this 11. And a provision is the liability. It's cost you expect to incur in the future. It becomes a current liability. This cost has been appropriately discounted. So you are the one as an accountant. Decontamination costs are taxed when the amount is paid, not a provision. When you pay, that's when you allow them. So that means nothing for now. Number three, the company had inventory. So we have an inventory. So the company had inventory with a carrying value of 24 million. So this amount shown in the financial statement by you as an accountant after doing all the necessary adjustment. The company had inventory with a carrying value of 24 million. This did not agree with the tax base because of 3 million written down. If it was written down, we adjust the tax. It was written down. So you do what? You add back. It was written down by an amount of, so that means initially was how much? 27. So you get a temporary difference of 3. They were written down 3 by Auma Limited for obsolete items. Tax relief is only granted for inventory upon sale. Good. Number 4, the company incurred 15 million with respect of development of a new software. Can you touch your software? No, therefore it's an intangible what? It's an intangible asset. The company incurred 15 million with respect of the development of new software during the financial year. The software was capitalized and will be amortized over the next 5 years. A full year amortization charge is required for the first year upon completion or purchase. This charge was deducted in the current financial year. So you as an accountant, you deduct what? Amortization. How much do you incur? 15. You raise amortization. So take 15. The estimated economic life was, and we are charging full year. And we're told that during the year they deducted that. So 15 divided by 5 you get. Then you take 15 minus 3 you get 12. This is the amount to be shown in the financial statement as the value of the software. What about tax month? 0. This is an intangible asset. So you get an amount of 12. Then I told that this charge was deducted in the current year financial statement. The company income tax rate is, give me the total. We get 21. So these are net taxable temporary difference. So therefore, how much will be our deferred tax? You take 30% of 21, you get 6.3 required. Our limited deferred tax liability as at 31st of July 2025 in accordance with IAS 12. Can take a screenshot. Do you think there is any question you have seen those past papers you cannot be able to answer for deferred tax? I do it now. Kama hujaiangalia sijasema uangalie size not. For those who have been doing revision, for those who can be able to identify any question that you think it require my input. Can try the last one here. August 2024. August 2024. Question 1B. August 2024. Question 1B. August 2024. Question 1B. So 1B, I told that Kivu Limited had the following statement of financial position and the tax basis as at 30th of June 2024 before providing for any deferred tax for the year ended 30th of June 2024. So you have the carrying values and then you have what? The tax base. So this is very simple. You have the carrying amount, you have the tax base. Let's start with the non-current assets. For the non-current assets, the first item we have is the factory building. The carrying value is 10,500 and our values are in 1,000. The tax base is an amount of 22,500. There is the planted equipment. Planted equipment. This is 156,000 with a tax base of 39. Then we have investment in Mina Limited. So it's another company. Can you see the carrying amount? It's an amount of 1977. Tax base is how much? So that means there is no temporary difference. There is long-term quoted investment. Both the carrying amount and the tax base are the same. No temporary difference. Current assets 45. That means there is no what? Temporary difference. Then there is trade payables 4,500. There is no what? Temporary difference. Then there is provision for repair. We say that what is a provision? It's a liability. Hata nyinyi mmeona imewekwa kwa liability. Are they the same? No. Provision for repairs. How much is the carrying amount? 900, and it's a liability. Liability show them as a negative, right? How much the tax base? Nil, because provision you are the one making. Taxman does not recognize for provision. Kwa hivyo ni zero. Kwa hivyo itakuwa ngapi? 900. And let's go to the equity. So for the equity capital is 30. They are the same. Then there is a revaluation reserve. Now for revaluation reserve, we'll come back to that because if we revalue an asset, mostly these assets, now that's when we take it to the revaluation reserve. Then there is what? There is long-term retained profit. No, we don't charge deferred tax on retained earnings. Also, retained earnings, goodwill, they're exempted from deferred tax. And now let's go to the non-current liability. To the non-current liability, what can you see? Long-term loans, of which they are not the same. Carrying amount is an amount of 30, but this is a liability. Liability show them as a negative. How much is the tax base? 33. Liability show them as a negative. Now take negative 30,000 minus negative 33. You get positive 3. The other one is a what? Deferred tax. All together. Now for deferred tax, now that one will give us the opening balance and the closing balance. Are they the same? I mean the carrying value and the tax base, are they the same? Yes. So we are done with what you are given. Added information. So for the added information, Kivu Limited acquired 100% of the equity share of Mina Limited on 30th of June 2024. The net asset at acquisition were as follows. So there is the fair value, carrying amount, and we have the tax values. Now the tax value, they are the tax base. So we acquired Mina Limited. Remember, this was a group of company. So there is factory building. There is the plant and equipment. There is the inventory. There is account receivables. And then there is the current liabilities. Twende kwa tax base. You are given the tax value. Freehold building is an amount of 300. The other one is 45. Inventory is an amount of 342. Receivable is an amount of. Then current liability is an amount of 300 and it's a liability. Then apart from the tax value, kuna fair value na kuna the carrying amount. You acquired a new company. You are given the net book value of the carrying amount and the fair value. As an accountant, when you are recognizing them, do you recognize the carrying amount or the new fair values? Fair values, correct, the revalued amount. So therefore, freehold building or factory building was an amount of, you take 15, this one you take an amount of 120, you take an amount of 370, 330, and you get 490 negative. Now give me TDs. 1500 minus 300, you get 1200. 120 minus 45, you get, is it 75? 375 minus 342. Get that right? 330 minus 330 0. Hiyo hata huko unafaa kuonyesha ni sawa tu because we have already recorded. Then negative 495 minus negative 315 180. Positive, negative. Negative. Good. Note number two. Note number two. During the year ended 30th of June 2024, that's at the end of the year, Kivu Limited, that's the parent company, decided to revalue building at 150 and plant and equipment to tuangalie hapa hizi hapa. Building and plant and equipment. This was the carrying amount, but now they have decided to revalue. So, as an accountant, will you take the original carrying amount or the revalued amount? Revalued. Kwa hivyo uta-recognize an amount of how much? 150 million. Remember our figures are in thousands. And then for the plant and equipment was valued to 180. Now give me the temporary differences. 150 minus 22,500, you get 122,500. 120? 127,500. What about this? Is it 141? And therefore, we'll come later to that. You see, we revalued them. So therefore, there is the revaluation gain and revaluation error. Revaluation changes for PPE and available for sale. They are subjected to special deferred tax. Special deferred tax. Good. Read number two again. During the year ended 30th of June 2024, Kivu Limited directors decided to revalue building at 150 and plant and equipment to 180. Investment were not revalued. Kivu Limited building had a cost of 135 and the plant and equipment was how much? 210. And that's why in our financial statement there was a revaluation reserve. Number two. Number three. The corporate tax rate for the year was 30%. 3. Number 4. During the year ended 30th of June 2024, directors of Kivu Limited agreed to provide 900,000 for future repairs for the building, for future repair. What is that? Provision. So, of 900 for the building. The expense is allowed when paid for. Umeiona mahali? Usiandike hapa tena, si ndio hii? Umeiona? House provision for repair, an amount of how much? 900. Number 5. The grant received was from IMF and was not it was not taxable. So if it's not taxable, therefore will not be assessed. It's not subject to deferred tax. 6. Goodwill on acquisition is not allowed for tax. Yeah, we say that goodwill, also the goodwill that they are exempt for deferred tax provision. Number 7. During the year ended 30th of June 2024, Kivu Limited acquired long-term loans for how much? 33 and recorded net of transaction cost. That's at the end. The transaction cost of 3 million is allowed for tax purposes. Have you seen that one? Okay, walichukua loan ya ngapi? Ya 30. Sawa sawa. Kwa hivyo wewe ulipokea pesa ngapi? So ulipokea 30? Yes. Umeambiwa that is net of. Tusome tuelewe. Unajua sasa hapa uzuri sasa hii topic na ile nilifanya ya kwanza. Do you remember financial liability? If you take a loan, ulikuwa unatoa transaction cost. Kwa hivyo the fair value, the amount to be shown in the financial statement should be net. Sawa sawa. Na ndio hiyo tumeelezewa hapo. Umeambiwa during the year ended 30th of June 2024, Kivu Limited acquired long-term loan of 33 million and recorded net of transaction cost. Kwa hivyo ulirekodi ngapi? What you recorded is what we call the carrying amount. You took a loan of 33, you incurred a transaction cost of 3. Kwa hivyo ilikuwa ngapi? Ndio that. But you are told that the transaction cost of 3 million is allowable for tax pa? Kama iko allowable. You see, this tax is the amount allowable for tax pa? Ni 30 na ulikuwa umeincur transaction cost of 3. Kwa hivyo mpaka itakuwa allowed for tax purpose in the future. It is an amount of 30. Na tumemaliza. Give me the total. 271, 725. So give me the deferred tax liability. 271, 725. Sorry? 81, 517.5. Now, what was the question? Calculate the deferred tax expense. Wanataka expense? The expense, that's when I prepare the deferred tax account so that you determine what do you take to the P&L. It's very simple. So you come up with the deferred tax account. Balance brought down. Go back to the statement of financial position. How much was the deferred tax at the beginning? 27, 030. The balance carried down is what we have, an amount of 81,517 point. And then we see that revaluation changes for PP and available for sale, they are subjected to special deferred tax treatment. So there was revaluation gains. And we revalued two items. Number one was the factory building. Also, we revalued plant and equipment. So you take 30% of the revaluation gain. Factory building, was evaluated to how much? 150. And the plant and equipment was evaluated to 180. How do you determine revaluation gain? By comparing the carrying amount against the revalued amount. Go back to the statement of financial position. The original amount nilikuwa nimeandika hapa, that's what we need. Also, go back to the financial statement. The factory building, the carrying value was an amount of 10, 100, 500. What about plant and equipment? The carrying amount was 150. Those were the carrying amount. So from 10,500 to 150, that's again by 0.9500. Then you take 30%. Sorry? 850. From 156 to 180. That's an increase by 24, right? 2400 times 3, you get? Sorry? 7,200. So it's still an increase. So how much do you take to the P&L as an expense? Because it's an increase. So this is 81,517.5. 81,517.5. So how much do you take to the P&L? You get an amount of? For that 7 point? If that's, I'll get you 12 marks. That marks the end of our class today. So you can take a screenshot.